Hello everyone and welcome to the Do More With Your Money podcast. Absolutely delighted to be here today. Title today, The Stages of Moving into Retirement. And I don't think we've got any retirees here, but we've got three people that will help with retirement, three advisors. We've got, we'll start with you, Sophie Bennett. You've been here for, how long have you been True Potential for now, Sophie?
4 years this month.
4 years this month, wow. And then we've got Andrew, or Andy Buick as we know you.
Yeah.
And this is your first podcast today?
It's my first one, yes.
We'll come back to you in a second. And Neve, we know you very well. I do, but this will be your first podcast as well.
Yes, my first podcast too, yeah.
Yeah, so I think, how long have you been at True Potential for now?
Nearly 5 years, 5 years in February.
Yeah, I did your initial interview, that's why. So
yeah.
Pleased you're still here. We obviously did something right at the time. So why don't you two guys introduce yourself, please? Just tell us a little bit about yourselves. I'm sure some of our clients on the line have probably heard your voice or seen you on a video.
Probably, yeah.
But please just share a little bit. Start with you, Andy.
Yeah, so my name's Andy Buick. I'm one of the senior financial advisors here. I've been with True Potential for about 2.5 years, but I've been in the industry for coming up to 9 years now. Started at St James's Place, worked my way through, and here I am now, hopefully helping people with their retirement.
Brilliant. And for 5 years?
Yes, yeah, so 5 years. I started off in the occupational transfer team and then did my exams through COVID, and then after that kind of became a financial advisor, and I've been on the head office team for 2 years now.
Yeah, excellent, brilliant. Well, hopefully we can give some top tips to our listeners today, everybody. Right, so we're going to split this into different stages of retirement and what we'll look at. So we're going to start off with stage one or section one, which is planning for retirement. So I think we'll start off with you, Andy. What's the sort of things that you would expect a client to do when they're sort of planning to build for their retirement?
I think the main thing clients really need to do is put as much money as they possibly can into their pension. As I say to people, the more you put in, essentially, the sooner you can retire, or the more you can retire on when you come to retirement itself. We often get the question, how much should I be putting in? My answer to that is usually always the same, as much as you can afford. So it's not going to have a detrimental impact on your standard of living at that moment. But like I say, the more you put in, the better, essentially.
Yeah, I think one of the key things I say to when family and friends ask is, there's never a bad time to start saving.
No, absolutely not.
Never is, but actually the earlier you start saving, the better it is, because of that compounding effect of it being longer in a market. And what sort of types of products are you thinking about when you're considering retirement? What sort of products are you
I mean, the main one's pensions. So you get your tax relief every contribution that you're making. You get your marginal rate of income tax either added onto that, or you can claim it back self-assessment. We've got ISAs. So the benefit of an ISA there is that you're going to be able to take tax-free income somewhere in the future. Typically a mix of the two is usually a pretty good way to go, because it means you can then structure your retirement around sort of the most tax efficient way of drawing income.
Yeah, I think it's always like we've had this podcast quite a few times, pensions and ISAs, what's the better way, but it really depends on your personal circumstances.
Absolutely,
I think that's one of the key things. Talk me a little bit about pensions, Neve, in terms of the benefits from that perspective and tax relief, etc., what you can get.
Yeah, of course. So when you put into a pension, you'll get tax relief automatically at 20%, and then if you're a higher or an additional rate taxpayer, you can then either contact HMRC and claim that back, or you can do that via self-assessment as well. So that's a really good route to save into your retirement, just because of the tax relief there. And then you'll also have your 25% tax-free cash when you come to take from there, and the rest will be taxable at your marginal rate. Another thing to think about as well is state pensions. So your state pensions based on your national insurance records, and with 35 years of contributions, that will be the full record. If you have any gaps as well, you can look to make class-free national insurance contributions and kind of make those directly and pay for those to get the full state pension there.
Yeah, that's a really good point. So if you kind of done enough years, not enough years, then actually go online, you can actually see how many years you've contributed, and it may not cost you as much as you think in terms of adding that in there to benefit from full state pensions. So it's worth considering that, especially if you potentially had some years out of work for children or other reasons. Considering that is definitely an option. And one of the big questions I get asked is, how much should I save? So we do a bit of goal setting on our technology. Sophie, I don't know if you can just talk through that.
Yeah, absolutely. Well, like Andy said, it's a really hard one, isn't it, to say how much everybody should save. We all sort of have slightly different circumstances, but it's a good way of starting off with what you think you're going to need, and in turn setting a goal. So you can speak about that with your financial advisor and set your goals in place, but actually you can have a play around on the technology. You can put in how much you think you might want at retirement, and it'll show you how far off you are. And it'll even work out something like, okay, to reach that goal, if you pop in an extra £50 a month, you're going to hit that goal sooner, or you're going to hit that goal at your target date. And it's a good thing to be able to play around with, because sometimes a really small increase in regular contributions can make a massive difference in 10, 15 years' time. I didn't realise myself until I had a go on it personally how much of a big difference when, you know, it's compounding and it grows over time.
Yeah, you've got a few years till retirement, so it definitely would make a huge difference.
Yeah.
Maybe it's not as much for me, but it's certainly, I totally agree with you. And I think this is one of the areas when I speak to clients or even friends in some respect, is it's worth you assessing, especially when you're setting your goal and your objectives, it's worth you assessing what your options with your employer as well. So typically, most people in the UK will have been auto-enrolled into a pension scheme, where there will be a level of contributions that are set as a minimum standard. However, it's worth you considering, actually some firms will do matching, so they'll say, well, if you put 5% in, we'll put 5% in, or 10 and 10. And it's worth considering that with your firm if you haven't already, because that can make a big difference, once again, just coming out. I kind of find sometimes with your workplace scheme, like just coming out your salary beforehand can be helpful. Yeah. But I'm sure you how do you speak to clients about goals and objectives when it comes to retirement at old age? You must obviously spoke to many clients, Andy.
Yeah, I think it's a tough one, really. It's almost you start at the end, what are you going to need in retirement? People will tend to look at it and say, do I need what I'm earning when I'm actually working? Is that going to be enough? Is it going to be less than that? I think typically people will land on a figure. That's what we do. We go through the expenditure templates with them, and we find out what the household expenditure is going to be in retirement. How is that going to change? Is there going to be things like travel costs, for example, reducing, and things along those lines? Are things going to drop off? Is there going to be potentially more spend for things like holidays and outgoings there? So we typically will start with that point. What is it that you are looking for in retirement? And then from there we can sort of work back and say, well, what would be a reasonable figure to sort of get to that amount of income? So I think it's important to look into that and know exactly what it is that you are going to need in retirement. I know it's a tough one for a lot of people, because obviously sometimes it's a how long's a piece of string question. But that is what we will do. We will sit down, we'll make sure we go through everything with the clients, just make sure that it's in line with what they're looking for.
Yeah, and I think when you're looking at it, we use cash flow tools as well, need quite often. So if you're your household with a couple, typically you'll both have state pension, hopefully full state pension and retirement. So that kind of gets you a certain level of income, but there's always that added extra income on top that you potentially need, which is where you bring in your pensions and your ISAs and other products, and you build that into the plan, wouldn't you?
Yeah, absolutely. And sometimes, for example, we sometimes have clients who take a little bit more, say they retire at 60 and they have to bridge that gap between retiring and state pension age. Knowing you can bridge that gap and then have kind of enough in your pension, enough in your ISA to do so, and then for the rest of your retirement can be quite handy as well. So we'd always recommend kind of getting cash flow modelling done if it's something you're thinking about when you're retiring, just because that can give a really good picture of how your finances can play out really to retirement. And we often forecast those as well to age 100. So that just mitigates against things like longevity risk, just making sure that you're not going to kind of outlive your pension and your other investments as well.
Right, so we've talked about putting money into your pension. Talk to me a little bit about the limits that you can put in terms of amounts, etc. And let's extend that out to other products as well as ISAs, just so everyone's fully aware.
Mm-hmm. Yeah, so for your ISA, that one's really straightforward. It's $20,000 per year, per tax year, that you can put into your ISA. We actually have a flexible ISA. So if you make any sort of withdrawals out of it, you can put that amount back in, plus your $20,000 within the tax year. But as for your pension, it's up to £60,000 per tax year, or your amount of earnings, whichever is highest. So if you're only earning £40,000, that would be your maximum. But it's worth remembering this includes, your employer contributions, your tax relief, things like that. So anything that goes into a pension sort of adds up to that allowance.
Yeah, and I think what we find, I've spoken to business owners before, I'm sure you have, and quite often the accountant comes typically about a day before their year end, and gives us plenty of time to do this. But it'll go, you can put in a pension contribution from an employer perspective. And that's helpful in a number of ways. It can reduce corporation tax in your limited company. But actually, it's a really helpful way of sort of utilising your allowances as well. I'm sure you two have both come across this quite often. Right, okay, let's go to the transition to retirement, because I'm very aware, so this is stage 3. It's a different conversation when clients are coming to retirement, isn't it, guys? I think this is, you've probably had quite a number of conversations with clients where they're thinking of retiring, they kind of want to know, can I retire? So just unpick that a little bit for me. Tell me how that works.
Yeah, so essentially sitting down with myself, Niamh, one of the other advisors, we'll discuss what it is you're looking to do in retirement, how are you going to fund that, what level of income would you need, and from there we can essentially put together a recommendation and say, based off what you're looking for, we would deem this to either be suitable or not suitable, depending on what level of income they're looking to take from their plan. We do use sustainability rates, so essentially what we would deem to be safe, depending on, obviously there's a couple of factors that can influence that, the level of risk that you're looking to take, for example, and again, what your plans are. Is that income going to remain level? Is it something that's going to drop down over time? Typically we will see that people are going to spend a lot more in their early 60s, for example, than they are in their late 80s, and essentially we will assess that and we'll say, based off what you're looking to achieve, we recommend this amount, and we recommend it coming from whether it be tax-free cash or taxable income, to make it as efficient as possible for you. And essentially that's what we do with the client from sort of start to finish when we're looking at a drawdown process.
It's a funny one, because I've helped a number of friends enter into retirement, and the conversation you're having with them, first of all, is, are you ready to give up work? You know, because actually you turn into a little bit of a justifying that this is the right decision for them, because actually not going to work every day can be pretty difficult. But also then you start to go, and well, actually, what are you going to be doing outside of work at that point? So when we're looking at your expenditure and we're looking at, well, are you going to be having more holidays? Are you going to see more of the family, etc.? It started bringing different types of expenditure on that basis. So you're starting to kind of draw a picture of what their retirement looks like, so you can then put the plan in place. It's really interesting. I just helped out a family quite recently where the lady is not quite at retirement age. Her husband's a little bit older, and he has a pension in drawdown. And one of the actions that we put in place for them was to draw slightly more out of his pension this year to let her retire that year earlier, because she was 100% ready to retire. This lady was a teaching assistant, so I think, quite a challenging role, working with children. And she decided to retire a year earlier. We managed to draw some income from that pot. And actually now we've started to take a bit of to her pension as well on the back of it. So it was just planning, and we were able to put some cash flow, and I'll say, well, actually he had enough money and it was never going to be a worry from that perspective. So I always find with that transition to retirement, that planning for retirement is sometimes that conversation of what your life's going to look like, and how we as a business and advisors can help clients do that. I'm sure you two have had many conversations and examples of that as well.
Yeah.
Good stuff. Let's go to section 4, post-retirement. So what do we do on a post-retirement basis? So I've retired, I'm taking some income, I'm taking some plans. Niamh, I'll go to you. What would you expect from an advice perspective? What would you be doing?
So once you are retired, it's important to kind of review your circumstances every year. So say if we set off and kind of recommend a withdrawal from your pension, if it gets to kind of the next year after, that may no longer be suitable. So it's always good to get that reviewed on a yearly basis, check your pension's still invested in the right place for you. We often get people moving into maybe a little bit more cautious portfolios as they retire, just because naturally their focus has gone from kind of looking for that growth in the pension to safeguarding what they have. So it may be checking that's still invested in the right place, checking the income is still sufficient, and maybe, for example, we have clients who start retiring and then they have a defined benefit pension maybe that kicks in at 65 and then a state pension at 67. So just kind of restructuring those withdrawals to make them tax efficient once that extra income is taken into account as well.
Yeah, once again, it's quite an interesting thing where that yearly review. What I always say to clients is, if you've got money in the bank, more money than you start with at the start of the year, you're probably taking out too much.
Yeah, absolutely.
And there's all sorts of benefits of keeping money in a pension. One of them will be inheritance tax planning. I don't know, Andy, you maybe just share a little bit on that.
Yeah, absolutely. So with a pension, it's at the minute. We've got a budget coming up towards the end of this month, so let's see how that changes. But at the minute, a pension is entirely outside of your estate as far as inheritance tax is concerned. What that means is essentially it's safeguarded. You're not going to be paying any inheritance tax when that passes to your beneficiary. You can pass it to whoever you want that to be now. Recently that changed, so you can pass it to whoever you want a beneficiary to be. It doesn't need to be a spouse or a partner. It can go to children, it can go to friends and family if that's what you'd prefer. In terms of actually passing over, as long as your plan is within the drawdown phase or as long as it's within the pension itself, it will go in its entirety to whoever your beneficiaries are. You can split that however you want in whatever percent you want as well. But it's not the same as, say, with an annuity, where 50% would go to whoever it was that you were looking for, typically, depending on how that was structured. With a drawdown, it will go to whoever you want it to go to in its entirety. So yeah, it's outside of your estate as far as inheritance tax planning is concerned. We would look at the ISA and other investments that you've got. They're not typically as tax efficient when it comes to the inheritance tax planning. That's why you would need something like a will put in place. Usually a solicitor will put a will in place to make sure it's going to the right person. But we can utilise things like trusts to make sure that we are keeping that outside of your estate where possible.
Great, brilliant. Thanks, Andy. Let's just go back to section 4 for the post-retirement, and then we'll finish off. But I'm quite keen on just explaining the art of actually taking out slightly more in the earlier stages and reduce it in the later stages, because I think sometimes we have a safe withdrawal rate of about 4% in terms of, we say to a client that you effectively, if you're going to take 4% out of your plan, and you effectively won't run out of money for a period of time. And I think what I think is quite important is just to try and unpick the fact that actually you can withdraw slightly more out earlier and reduce it as you get older, because we tend to want to spend more as we retire and then less as we get older. So something you guys recommend quite often, Niamh? I don't know, that's something you...
Yeah, so we often find that people perhaps have a higher income need when they first start to retire, especially if it's before state pension age, just because naturally you don't have that other source of income coming in from your state pension. And so it may be the case that we say, even though that's more than 4%, which in a kind of normal circumstances we wouldn't consider that a safe withdrawal rate, actually because you're 65 and you're only going to take that for 2 years, that can be considered sustainable. It's not a permanent withdrawal, and actually kind of going forward after that, your withdrawals are looking to be less than 4%, so that's absolutely fine. So the 4% kind of isn't really a hard and fast rule, it's more like a guideline, and we appreciate that it may be that, for example, as well, you're spending more to start off with. A lot of people, when they first retire, they want to, and rightly so, go on a nice holiday, or they've had a cruise they've always wanted to do, and the first 2 years perhaps they want to kind of factor that into their expenditure. But then after that, they'll kind of go back to normal holidays. So it absolutely can be the case that if it's only for a couple of years, you can take more than that 4%. It's kind of more of a guideline really than a hard and fast rule.
Yeah, brilliant. Okay, section 5, legacy planning. I'm going to go, you mentioned beneficiaries before, Andy, and actually I think this is quite an important thing. So if you just to talk around how a client would set up that expression of wish in terms of wanting their pension to, because although we get high numbers of clients that will set their beneficiary, so if, sadly something happens, we know who to go to, we still have a number of clients that don't, and we really encourage them to do so. So I don't know if you can just talk clients through how you would do that.
No, absolutely. So you can do this on your True Potential client site or on your app. So you would log in. It's important to note that this is only available for your pension. So as Andy mentioned before, your ISAs, your general investment accounts, they do form part of your estate. So it's just for your pension that we can sort of set up and deal with these, the beneficiary side of it. But in terms of that, you can go onto your site and you can click on the policy, scroll down and click to add your beneficiaries. You can just add them there on the site. You can choose, if you wanted to split it 50-50, if you want to include a percentage that goes to a specific charity. It's all included there. If you needed a hand with it, of course, you can give us a call. We can help you get that set up. But it is really, really helpful when, unfortunately, that time does come and we've got the details on hand of, who we can call, and we can get your funds passed over to them in the way that you wanted, and the advisors like these guys are there to help and support them do that, because it's a big transition for everybody involved, and it does, it's a bit of peace of mind as well, isn't it, to know that we've got the wishes on hand.
Yeah, no, I totally agree. And something I've done, and I would, encourage other sort of customers to really look at, is typically your beneficiary will be your partner, whether it's your husband or wife, and I actually have a small percentage of my pension to my children, And they're only young at the minute, but the idea is you have that conversation with your children and bringing them as part of that planning, because there's probably a likelihood that they will get a benefit in the future. So it's worth thinking about that. Yes, it's worth obviously encouraging your partner, but also maybe potentially looking at your children as well. You also mentioned, Andy, before setting a will. And we've mentioned this on a number of podcasts, but Niamh, I'll let you over. What's the importance of setting a will?
A will's just, it is important just because you have your wishes that you have just in writing, and so when your estate is sorted out, you can see clearly who it wanted to go to, who you wanted to benefit from your will, and you've got those wishes in writing, which can be important, especially in cases where, say, you're not married to your partner. It can be the case that they'd be left out of the will, so it's good in those cases to have that person in writing in your will. Yeah,
definitely. I think it's especially if you've got children, worth looking at that, because you've got different considerations as well. It would be the first thing I would say to somebody needing advice. If you haven't set up a will yet, I would really encourage you to do so, because it is, although it might seem a distance away, it can be incredibly problematic if you haven't got one set up for your loved ones. Thank you very much, everybody. I think just to close, there's a couple of things that we've kind of picked up from there, but there's definitely different journeys throughout planning, and from our client perspective, we are available at any point during those journeys, whether it's a discussion of am I putting enough in my pension, or if it's a discussion how much I should be taking out, or it generally is am I taking enough out, or am I taking too little out? Some questions that I get from people is can I take a bit more? Is that sustainable? These are the questions that we are here, and your advisor is here to help you with. So please do ask those questions, because it can be really important when it comes to that final planning. So thank you very much, folks. Hope you enjoyed your first podcast. Your debut. I'm sure we'll see you again soon. Please do subscribe, share on social media, give us any comments that you feel, or if there's any podcasts that you would like us to talk about, please pop them in your comment box. We'll be delighted to engage on that basis. But for now, thank you very much. We'll speak to you all soon. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.